Hi there, good afternoon. You're watching the Mutual Fund Corner. I'm Mangla Malu. With me is Sumaira Abdi in the Mutual Fund Corner. Remember, today has been the RBI policy day, so we'll also answer, along with your equity mutual fund queries, we'll answer your debt portfolio queries as well. How does the RBI policy impact your debt mutual fund portfolio? But before that, we take a look at the markets. It's been a whimper of a day as far as the markets are concerned, despite the sort of events that there were, and primarily because the street had digested in a 25 basis points rate cut before, much ahead of the RBI policy announcement itself. The Nifty has been meandering around the flat line. There was a bit of volatility around the policy announcement time. Apart from that, the interesting moves are coming by on the currency as well as the IT space. While the rupee is at the low point of the day, it has come considerably off the highs, and it's currently trading closer to the lower end of today's trading range, closer around 69.7 paise. This to the dollar. The IT stocks, on the other hand, are also trading lower. Intuitively, there is an adverse or inverse correlation. Today, both of them at the low point of the day at the same time. Pull up something like a TCS, HCL Tech or Infosys. So can there be some support coming in from the IT pack in the last couple of hours of trade or not is the big question. Also, all focus on to the weekly options expiry. But first up, all the top stories, and then we hand it over to Sumaira. The Reserve Bank of India cuts repo rate by 25 basis points. As expected, keeps the monetary policy stance unchanged at neutral. CPI inflation forecast is revised downwards, but the GDP forecast target for FY22 is cut from 7.4 earlier to 7.2. The equity market remains sanguine to RBI's rate moves. The Nifty and the Sensex see some volatility but trade absolutely flat. The Nifty Bank trades marginally higher. The rupee, however, extends losses to trade near the lows of the day. The RBI Governor Shakti Kanta Das stresses that all major cases referred to the NCLT will not be affected by the Supreme Court order that came in on the February 12th circular. Says the central bank may look at issuing a revised circular for resolution of stressed assets soon. Interglobe Aviation up 5% today after sources suggest that 10 to 12 unused slots of jet at Delhi airport have been offered to other carriers. Indigo has received 4 to 5 slots, while SpiceJet receives 6 to 7 slots. Dish TV gains after CNBC-TV18 learns that Singtel and Airtel are set to make a combined offer to acquire the promoter's 60% stake in Dish TV for over 6,100 crore rupees. With that, we hand it over to Sumaira, who's sitting by with a guest in the Mutual Fund Corner. Sumaira.
Mangalam, thanks very much for that. Manoj Nagpal of Outlook Asia Capital joins in to answer all our mutual fund queries today. Manoj, hi, good afternoon. But, before I get to actually getting you to answer the queries, today we've seen a 25 basis point rate cut by the RBI. So first up, what does that mean for a mutual fund investor, primarily the debt fund investor? So one thing, of course, is that, interest rates and bond prices, they're inversely related, right? So that means that when interest rates fall, bond prices will rise, and of course, vice versa. So a higher bond price actually boosts the NAV or the net asset value of debt mutual funds, because securities which are already held likely carry higher coupon rates than the new bonds. So falling rates therefore spell good news for debt mutual fund investors, although experts do recommend that you should not time the interest rate cycle, at least not for retail investors, because it is not something which is very, very easy. But is this the same for every kind of debt fund? There are various categories. So which category will benefit the most? What should you consider? For all of that, first, let me grill Manoj. Manoj, when an investor wants to look at debt fund, especially given the kind of year that we have put behind us, what should we consider? I mean, what are the top 4 or 5 things to look at?
Well, Sumaira, the way SEBI has defined debt funds is that there are now 16 categories of debt funds. That's a whole huge choice that SEBI has put out. There are 2 primary factors that, are there while, choosing a debt fund. One is the interest rate risk and one is the credit risk. When you start out by choosing, there are basically 5 factors one should look at while choosing a debt fund. One should start out with your investment horizon and, tend to match the profile of the debt fund with yours. So if you want to invest just for a couple of days, so there are debt funds which will help you invest just for 1 day, 2 days, 3 days, then you should choose a liquid fund or a fund which is or an overnight fund which is a very, very short maturity of 1 day. Similarly, if you have a horizon of 3 to 6 months, there are low duration funds, and if your horizon is 3 years plus, then one can look at a medium term duration fund also. So the first thing is match your investment horizon. The second thing is very important, as you highlighted, is that there are two risks: the interest rate risk and the credit risk, or the interest rate benefit also. So whenever interest rates are cut, obviously the bond prices start rising up, and that helps debt funds. But you have to really understand that today, when RBI credit policy has cut the repo rate cut, most of the time it should get translated into the bond prices also. But as you are seeing today, the 10-year GSEC has actually moved up. So the 10-year GSEC, is now trading at around 7.33, 7.44 as compared to the close of 7.3 yesterday. So there is no direct correlation, but because the market was expecting a much more from the RBI credit policy, and hence the market is now actually, reacting a little adversely. So those, interest rate cuts should ideally mean a, good thing for debt fund investors. In the current case today, it is not. So that's the second factor. Then one has to move on to, what is the credit profile of the entire fund, what is the yield, what is the average maturity, and what is the modified duration. These are three things you should always learn. What is the yield, what is the average maturity, and what is the modified duration. This gives you a clear sense of how the fund is structured. And fourth is the how the fund manager has navigated all the above variables that I'm telling you. So if you are able to get these variables right, that is how you go about selecting a debt fund.
Okay, so let's talk about a couple of them, at least the more popular ones. What about gilt funds? Are they suitable for every kind of investor?
Well, ideally, gilt funds are only suitable for the very, very sophisticated investor. Gilt funds are a vehicle which invests only into government securities. So the risk of default here is negligible because it's issued by the government of India. However, the maturity or the tenor of these funds are in the range of around 10 to 15 years. So what it means is that it carries interest rate risk. When an interest rate cut happens, these funds will gain the most. So if you are trying to play the interest rate cycle, so if you are going to believe that interest rates are going to be cut substantially going forward, you should choose a gilt fund. But this is not for a normal investor. This is only for a very astute, sophisticated or institutional investor that they should prefer gilt funds. I would ideally advise that retail investors and all HNI investors also should ideally stay away from gilt funds because those are more of timing instruments. If you want to time the interest rate cycle, only then you should do it. Ideally, don't do it.
Okay, also there is now this expectation that since a 50 basis point cut didn't come this time around, perhaps it's going to come a little later on. In this situation that, you're expecting further rate cuts, what's the kind of fund that would be suitable?
Yeah, so if you're an investor, the way you analyze, investing into fixed income instruments. Now, the very thought process of an investor when he's investing into a fixed income instrument, whether it's a fixed deposit, whether it's a debt mutual fund, they want, consistency of return. So if there is a debt instrument which is giving them, say, 7 to 8% return, the mindset of Indian investor is that he wants that 7 to 8% come in very, very regularly. Now, in debt mutual funds, primarily this is not true because they are very sensitive to interest rate movements. And as you rightly said, currently we are in a scenario, and India has been in a scenario wherein the inflation has now tapered down to 4%. RBI has given a target range of 4 to 6% for inflation going forward. And we are already at a band where we are around 4%. So expectations of a rate cut and whether they materialize or not is something very, very, at this point of time, not very clear. So ideally, one should assume that we will be in a narrow band of, the interest rate will remain a range-bound manner. And hence, one should ideally choose medium-term funds or corporate bond funds or FMPs, fixed maturity plans. Because fixed maturity plans actually mimic more the expectation of an Indian investor.
Okay, where do dynamic bond funds fit in? Yeah,
when you're looking at, when you don't want to play the entire interest rate risk cycle, but you still want to, do a balance of credit risk and also a little interest rate risk, that is where we ideally say that an investor should ideally look at a dynamic bond fund or a long-term income fund, which is the generic category of income fund. So that is the time when one should do it. Dynamic bond funds will help you primarily move across the interest rate curve. So if the fund manager feels the interest rates are going to get cut, he will increase the maturity. If he feels they are not going to be cut, he will bring it down. So he's taking away that decision from you and doing it himself, and that's a good way to go about.
Okay, so leave it to the expert, right?
Leave it to the expert there, yeah.
Okay, credit risk funds. Now, this is a category which has been quite controversial, in the last few months odd. Is it still a category that's liked by retail investors or should be liked by retail investors?
Well, the credit, as I said, if you were to take away the interest rate risk out of your debt fund portfolio, which is because it's very difficult to play, it's not a right model that one should go ahead for a retail investor. The credit risk funds or accrual funds, as we have known them earlier, are very good bets to look at. However, one has to take that call that there is a credit risk in that and you should expect a default. If there is a credit risk fund that comes in and tells you there is not going to be any default, I would stay away from them. Hence, expect a default, look at the total yield of the portfolio, assess the risk that is there, do it with an advisor if you don't want to do it yourself. And if the yield of the portfolio is around 11% to 10% to 11%, expect a 1.5 drop in yield because of the credit risk and then expect your returns from them. That's a good way to do about it. Also look at the fund manager, how he has managed the credit risk in the past. And the last year has given us a lot of these instances.
Okay, what we